One of the biggest myths banks tell us is that our money grows while sitting in our accounts. The reality is, while the number in your account may increase due to interest, the actual value of that money doesn't grow, especially when inflation is soaring and bank interest rates are lagging behind. Keeping cash in the bank is actually eroding your wealth. In this video, we're going to share 6 assets that will help you preserve your wealth and even create intergenerational wealth. Number 1. God's money: gold, silver, and platinum. One of the main reasons money is considered valuable is its ability to store value for the future. However, as governments print more money to cover deficits, you never know when that dollar in your pocket will lose its worth. This is why financial experts recommend investing in scarce, valuable assets that can't be easily reproduced. This is why the wealthy always keep a portion of their portfolio in precious metals. Metals like gold, silver, and platinum tend to rise in value, especially when inflation is high. For example, before the 1950s, an ounce of gold was priced at $400. In 2023, that same ounce is valued at over $2,000. Prime XBT's forecasts even predict that gold prices could reach $10,000 by 2032. So while cash loses value, gold continues to appreciate. Similarly, other precious metals offer better value preservation than holding cash. If you're wondering how to gain exposure to gold without buying physical gold, you can invest in gold ETFs, which are affordable and track gold's price movements without requiring you to hold the metal physically. Number 2. Industrial commodities: raw materials. While precious metals are valuable due to their scarcity, they also have intrinsic utility, making them essential industrial commodities. For example, silver is used in electronics, medical equipment, and even nuclear reactors. Other metals like cobalt, nickel, and copper are also in high demand due to their unique properties that are difficult to replace. To give you an idea, since 2020, the demand for cobalt has skyrocketed, mainly due to its use in electric vehicle batteries. Consequently, cobalt prices have doubled from $20,000 per ton in 2012 to $40,000 in 2022. Therefore, having exposure to such raw materials can significantly enhance your portfolio during high-demand periods. However, not everyone can invest large sums in raw materials, nor can we store them or find the right buyers easily. Therefore, investing in mining company stocks, mutual funds focused on mining, or derivatives like futures and options are excellent ways to gain exposure to these commodities. Number 3. Safe haven currencies. In today's world of fiat currencies, where no currency is backed by gold, geopolitical stability becomes a crucial factor in where you invest your money. This is why the wealthy often keep their money in Swiss banks. Switzerland, with one of the world's strongest economies, offers a stable geopolitical environment, making the Swiss franc a safe haven asset during times of turmoil. We've seen this during the Eurozone debt crisis in 2009 and the global financial crisis in 2008. Where significant funds moved to Switzerland to avoid wealth erosion due to currency depreciation. The Swiss franc also serves as a valuable alternative to the US dollar for international trade. For example, during the recent Russia-Ukraine conflict, when the US imposed sanctions on Russian energy trade, Russia executed trades in Swiss francs, boosting its demand and causing it to appreciate against other currencies. In early 2023, one Swiss franc was worth 1.1074 US dollars, significantly increasing the wealth of those holding Swiss francs. Therefore, currencies like the Swiss franc, British pound, and Chinese yuan are excellent stores of value. If you can't open a Swiss bank account, currency ETFs and forex brokers like forex.com allow smaller investors to gain exposure to these currencies with as little as $100. Number 4. Sovereign guarantee. Have you ever closely examined a dollar bill? It says this note is legal tender for all debts, public and private. Ever wondered what that means? Since 1971, when President Nixon abolished the gold standard, the dollar became legal tender by U.S. law, making it valuable as a medium of exchange. Although no fiat currency is backed by gold or any physical asset, they are still backed by the full faith and credit of their governments. In simple terms, your money is as stable as the government that backs it. This is why investing in sovereign guarantees is a valuable way to store value. A government is always the last entity to default. If it does, the entire nation defaults, and no strong government will let that happen. Therefore, investing in government securities, or GSECs, is one of the safest ways to store value. However, only stable government GSECs with investment-grade credit ratings should be considered. Remember Greece's sovereign debt crisis in 2009? The IMF, Eurogroup, and ECB had to bail the country out of its debt multiple times. Therefore, a government's global strength should always be considered when investing in GSECs. In the US, you can invest in treasury bills, notes, and bonds to gain sovereign guarantee exposure. These offer better returns than keeping money in the bank and are backed by the strength of the US government. Small investors can buy Treasury securities directly from the government through the Treasury Direct portal or the secondary market. Number 5. Value stocks and mutual funds. Treasury investments provide better returns than cash, but because they are low risk, they offer lower returns than stocks. While low risk is important for conservative investors, most investors seek higher returns, and stocks are a great way to achieve that. However, not all stocks are equally risky. The stock market is generally divided into two types: value stocks and growth stocks. Growth stocks, like technology stocks, are riskier because they deal in ideas and technologies with high failure potential. On the other hand, value stocks, like those in companies dealing with industrial metals, are less risky due to their established demand for the foreseeable future. Value stocks with strong fundamentals not only provide steady price appreciation, but also offer stable dividends. However, researching the fundamentals of every value stock can be time-consuming and cumbersome for the average investor. Therefore, dividend-focused mutual funds, like the Vanguard High Dividend Yield Index Fund Admiral shares, with a stable dividend-paying history, are ideal and affordable investment vehicles for retail investors. Number 6. Land and real estate accountants classify land as a non-depreciable asset for a very good reason. It is scarce and always in demand. Since the beginning of time, land has been one of the most valuable resources in the world. We need land for homes, schools, factories, agriculture, and commercial spaces, among other uses. And with a growing human population, its demand will never decrease. Similarly, residential homes, office spaces, and commercial properties built on land are also always in demand. Therefore, both land and real estate serve as excellent inflation hedges in your investment portfolio. To give you some numbers, according to a Bloomberg study, housing prices have tripled between 1992 and the 2020s, despite a significant dip during the 2008 housing bubble. Therefore, having real estate exposure is always beneficial when the dollar starts losing value. However, most small investors consider getting into real estate much later in life because they only think of real estate in terms of the house they live in. While owning a fully paid-up home is a net worth goal for when you're in your 40s, having a slice of the retail property market is recommended at any age. Contrary to popular belief, you don't need a lot of money to gain real estate exposure. You can invest in REITs, real estate investment trusts, which are similar to mutual funds but for real estate. One of the most popular REITs in the US is Ventas Inc., VTR, which invests in healthcare real estate, including senior housing, research facilities, and hospitals, among others. Alternatively, you can borrow to own rental properties, where the rent will cover the expenses and mortgage payments, and also bring you some profit. Number 7. Collectibles. Collectibles like vintage cars, rare art pieces, handcrafted luxury handbags, limited edition watches, and even the first editions of iconic books fall into this asset class. While regular cars lose half their value as soon as you drive them off the lot, vintage cars work in reverse. They appreciate over time. In fact, according to Autocar, a 1955 Mercedes-Benz 300 SLR Uhlenhaut Coupe was sold in 2022 for a staggering €135 million. Only 2 of these cars were ever produced, making them rare collectibles. Similarly, in 2017, Leonardo da Vinci's most controversial painting, Salvator Mundi, was purchased for a whopping $450 million at a Christie's auction by a Saudi prince. The reason the wealthy spend so much on limited edition items is that these unique pieces are timeless stores of value, capable of fetching unimaginably high prices if you find the right buyer. However, for average investors, investing in collectibles may seem like a distant dream. That's where online marketplaces like Whatnot come in handy, offering fantastic options for selling rare baseball cards, comic books, action figures, and more. And if you can't afford to buy the whole item, you can even invest in partial ownership of collectibles on platforms like Rally and Masterworks.